All right, so Huntington Bank shares just dropped their Q4 numbers for 2025. And if you just listened to management, you'd think everything was amazing, like they were firing on all cylinders. But then you look at the market, and it's telling a completely different story. So what's going on here? Let's dig in and figure it out. And this is the number that really tells the story. A 6% drop. Ouch. I mean, the stock literally hit a 52-week high the day before, and then, boom, tumbled. So the big question we've got to ask is, why? Why the massive disconnect? What did investors see that made them just slam that sell button?
Well, it really all starts where it usually does, with the headline numbers. While management's busy painting this beautiful, long-term picture, Wall Street, they're looking right here at the immediate results.
And right away, you can see where the trouble starts. Look at the adjusted earnings per share, the EPS. It came in at 37 cents, but the street was looking for something closer to 40 cents. That's a miss. And it was the same deal with revenue. They came in just a little shy of what analysts were expecting. Now, here's the thing. These numbers are actually pretty good year over year, but on Wall Street, it's all about expectations. And Huntington, well, they missed up. And believe me, the market's reaction wasn't just some small dip. It was a loud and clear verdict. Trading volume just exploded. We're talking nearly 87 million shares changing hands. That's more than double the recent average. This wasn't just a few nervous folks selling off. Nope, this was a high-volume day, which tells you that big institutional money was heading for the exits based on this report.
So what we've got here is a classic Wall Street standoff, a tale of two stories, really. In one corner, you've got this super confident management team talking all about growth and strategic investments. And in the other corner, you have a pretty skeptical market that's laser-focused on rising costs and big-time risks.
This slide really lays out the whole conflict, doesn't it? On one side, you have management's bull case, and they've got some good points. They highlighted fantastic core performance, like their net interest income, which is basically the profit a bank makes from lending, and that was up a huge 14% from last year. The CEO was even talking about a flywheel of value creation. But then you look at the other side, the market's bear case. They saw those headline misses we talked about, and they dug in. They saw costs spiking, shown by an efficiency ratio of over 64%, and all that means is it's costing them more and more to make $1 of revenue. And maybe the biggest thing, they saw a ton of uncertainty and risk in trying to swallow two massive new bank partnerships at the same time. And this quote from the CEO, Steve Steiner, it really sums up their entire mindset. He's saying, look, we're driving great growth and returns, and we're investing for the future. So in their eyes, these rising costs aren't a bug, they're a feature. It's strategic spending. The problem, though? The market's timeline is often a lot shorter than that. So here's the bottom line. On earnings day, investors just weren't buying that long-term story. They were pricing in the pain they could see right now. They saw the earnings miss, they saw the costs of these new deals going up, and they saw the very real possibility that mashing two huge banks together, well, that it could go sideways. That jump in the efficiency ratio, that was a massive red flag for short-term profits. Okay, so where does Huntington go from here? If they want to win back the market's trust, it's not about making more promises. It's about delivering proof. And there are some really specific milestones that absolutely everyone is going to be watching for in 2026. First up, they've got to officially close that Cadence partnership on February 1st. That's step one. Then, by the middle of the year, we need to see real, tangible progress on getting all their systems integrated. Step 3 is the big one, though. They have to prove, not just say, but prove that they can get their expenses under control and that those cost savings they promised from these deals are actually happening. And finally, they absolutely have to hit their net interest income target of around $8.6 billion. Hitting every single one of these marks is frankly non-negotiable if they want to get back in Wall Street's good grace.
All right, that brings us to our final segment, our take on what's next for Huntington. This is what we call the next call. So, after all that, the strong core business, but also the major risks, what's the verdict? Is Huntington a buy, a sell, or a hold right now? Our main thesis is this. Things are probably going to get a little bumpy before they get better. Look, integrating one big bank is tough. Trying to do two at the same time, that is a massive challenge. Any little hiccup along the way, a delay, some unexpected costs, a culture clash, is going to create some serious volatility for the stock. And because of that execution risk, we're expecting the stock to probably trade sideways, kind of stuck in a range for the next couple of quarters. The market is officially in a show-me mode. Until Huntington can actually demonstrate that these integrations are going smoothly and that those cost savings are hitting the bottom line, it's just really hard to see a major reason for the stock to push a lot higher. And for that reason, our rating is market perform. We're definitely acknowledging that solid growth engine that management loves to talk about. But at the same time, we're respecting the market's very real concerns about the cost and the sheer complexity of pulling off this dual integration. The upside potential is there for sure, but so is the risk.
And just as a reminder, this is not financial advice.